It's time we had a talk about rep status. If you're a real estate investor, you've heard of rep status. And if you're a real estate investor on social media, you might just think rep status is going to solve all of your cash flow problems and your tax burdens. But I'm here to tell you that rep status is great, but it can also be a disaster. Let's start off with what rep status is. Real estate professional status. This is a status that you can achieve. You can click a box on your tax return that tells the IRS, I have real estate professional status. And that allows you to claim your real estate losses against your ordinary income. In order to qualify for reps, you need to work 750 hours in a real estate trade or business, and that 750 hours needs to be more than any other work that you're doing. So let's suppose you work part-time, you work 20 hours a week, 50 weeks a year, that's 1,000 hours at your W-2 job, and you want to qualify for rep status this year. Well, if you've got 1,000 hours at your W-2 job, you need to work 1,001 in your real estate trade or business in order to qualify for rep status, because not only is it 750 hours, but it has to be more hours than any other work that you do. Now, in addition, you have to meet the material participation rules for your property. There are professions that count, there's work that counts. So if you're doing construction, you're doing rehab, leasing, managing, these types of things count. And there are things that definitely don't count. Going to an educational event, networking, driving, looking at properties, running some numbers on properties. None of these things count towards your real estate professional status. So 750 hours, got to be materially participating, has to be in a real estate trade or business that qualifies. But we need to talk about when reps is a disaster. And there are 12 times in which real estate professional status can actually be a disaster for you. The first thing you need to keep in mind is that there is no automatic designation for this. You can't take a realtor course and become a realtor and all of a sudden, boom, you have rep status. You still have to qualify for your 750 hours and your material participation. So that's the first time in which reps can be a disaster. The second way in which rep status can be a disaster for you is if you're not serious about rep status. Rep status is a huge audit red flag for the IRS. As I said, it's a simple checkbox on your tax return that anybody can check, and then it allows your losses from your real estate to apply against your ordinary income. So the IRS is likely to come knocking if you are qualifying for rep status. Now, if you are legitimately a real estate professional and qualifying as real estate professional status, you have nothing to worry about because you're going to show them that contemporaneous detailed log that you kept. That what? That's right, a detailed contemporaneous log that you kept of all 750, preferably more than, not exactly, 750 hours of work that you did. With that contemporaneous log, that means you were keeping the log when you were doing the work, and it has detail. The IRS will look at that and say, oh, thank you, Mr. or Mrs. Rep status. You're fine, carry on here, and you are free to claim that rep status. But without that contemporaneous log, you could have major issues with the IRS. The third thing for you to consider with rep status is that 750 hours, that's a lot of time. If there's 50 weeks in a year, because you take a couple of weeks off, you've got to work 15 hours every single week. So if you're a small-time real estate investor, you've got 2, 3, 4, 5 properties, and they're long-term rentals, and you have tenants in there, I really hope you're not spending 15 hours a week managing those properties and getting tenants in and out of there, because that would be a disaster for you. If you are a short-term rental landlord, then perhaps you could get up to 15 hours if you're doing all of the work yourself on the turnovers. But 750 hours is a lot of time. So you must take your real estate log seriously and consider before you go down this path, do I actually have 750 hours in my real estate trade or business in order to qualify for rep status? The fourth, and I've already mentioned it, and this is where rep status can be a disaster, it's really easy to just check that box and boom, you've got rep status on your tax return. So this is an integrity issue. You've got to do the right thing here and make sure you are legit a real estate professional before you click that checkbox. The fifth thing for you to be aware of with real estate professional status is that material participation in real estate has a definite and strict definition. This means if you've got property managers handling your properties, you probably don't meet the material participation rules. If your properties are triple net lease, you probably don't meet the material participation rules. So material participation is a major issue for you with rep status. You have to make sure you are involved 500 hours in your property or 100 hours and more time than anybody else in your property if you're going to check the box for rep status. Number 6 for rep status is a disaster is the grouping election. You've probably not heard of the grouping election. It's section 469 of the tax code. And what it allows you to do is group your rental properties together as one activity. Now, why would you do this? Well, you would do this to meet your material participation rules. So you can much more easily meet the material participation rules if your 5 rentals are grouped as one than on each individual rental property. But if you forget to check that box for the grouping rule, then you might fail the material participation test. And even if you have your more than 750 hours, rep status can be a disaster. Number 7, owning real estate in a partnership. This makes it much more difficult for you to meet the material participation rule. You have to materially participate in this real estate activity in the partnership and be the general partner. So it's possible to qualify for rep status in a partnership, but it's unlikely for most partners to do so. Number 8, even if you do everything correctly and you are legitimately qualifying for rep status, and you have losses on your tax return that apply against your ordinary income because you sped up depreciation, you used a cost segregation study and bonus depreciation, and everything is perfect and you're getting a big refund, and then comes your state tax return. You see, not every state accepts bonus depreciation. In fact, many states don't. I happen to live in Maine, and Maine rejects the idea of bonus depreciation. It makes you add back all that depreciation that you claimed. So that real estate loss that you think is so wonderful is actually a profit on your state return. So be careful because rep status can be a disaster. Number 9, rep status is not a once and done. You need to qualify for every year that you're going to be claiming those losses against your ordinary income. So be careful of this one. It can be a great strategy to say this is a particular year in which I believe I can qualify for rep status, and we're doing these other things so we can generate some losses so that we can have this cash flow to buy this next property. That would be a great opportunity for you with rep status, but be careful because rep status is a requirement that you have to meet each year. Number 10 with rep status, this is a little known one. This is when your passive losses that you've had from your property get trapped and you can't take them. This happens when you have a property that's in service, it's a rental property, you've rented it for a couple of years, you have losses that are carrying forward, and now you qualify for rep status. So if I had losses carrying forward from last year when those losses were passive, and now in this year I qualify for reps and the income is active, I can't apply that passive loss from the real estate against the active income from real estate. It's trapped. And it's trapped until either I no longer qualify for reps and my income from my rental property is back to passive income, or until when I sell that property. So be careful because those passive losses you've been carrying forward can get trapped with rep status. The 11th way in which rep status can be a disaster is, why are you losing money on your rental? Aren't we in this to make money? Now, I understand the strategies. I've done cost seg studies on my own properties. I get it. But let's make sure that we're doing the basics, that our rents are at or above market and that they're increasing every year, that our expenses are under control, and that if we're going to use reps as a strategy, that it's part of a larger holistic picture of what we're doing with real estate and where we're headed, and not just a fun, hey, I get to claim some losses. Let's make sure we're being excellent managers and stewards of these properties. The 12th way in which rep status can be a disaster is you do all this work and you have $25,000 of losses and your total income is under $150,000. You didn't have to do rep status in order to claim the $25,000 in losses. against your $150,000 of ordinary income, that's already allowed. So rep status is a strategy for higher income earners and not for lower income earners who are real estate investors, unless you're trying to claim more than that $25,000 in losses against your ordinary income. Number 13, and this is just to highlight all of the prior 12, TikTok reps is not tax court reps. So just because some influencer said, hey, click the box, get rep status, and claim all these losses, doesn't mean that when you show up in tax court, that the judge is going to agree that yes, you truly have rep status. So please do your homework, do your research, but most importantly, talk with a tax strategist about rep status. Make sure this is the right fit for you. You need to have a holistic picture of where you're going with this, not just a one-off, oh, this will be fun to have rep status, but what is your actual long-term plan with your real estate and your finances, and how does this fit in with that plan? See, at Management Accounting, our tax strategists take a proactive, holistic, long-term look at our clients' finances and investing so that we can come alongside, help them maximize the tax code so they can constantly reduce taxes and increase wealth.